Shares of Nvidia actually rebounding slightly this morning after sliding more than 6% yesterday. By the way, what he said about quantum computing managed to take out a lot of those quantum computing stocks, some of the smaller ones like IonQ, Quantum Computing, Rigetti. Joining us right now for more on all of this is Joseph Moore. He's Morgan Stanley semiconductor analyst. And Joe, I just want to get your take on this. I've been reading a lot of stuff. I mean, after Jensen Huang made his comments the night before last, we actually saw shares a little higher in the morning. Maybe not by a lot, but it certainly wasn't giving back the pullback that we saw later in the day. There were a lot of the tech stocks and other big high flyers that pulled back, though, after we got stronger than expected jobs numbers, just in terms of what the BLS had in terms of jobs openings, those JOLTS numbers. That had people suspecting that maybe the Fed is going to be more reluctant to cut rates anytime soon. And that caused all of these big high flyers to pull back. So do you think the pullback in Nvidia shares yesterday was more related to what Jensen Huang did or didn't say, or just more related to the overall idea of watching the Federal Reserve and seeing how the economy is doing?
I mean, I think both of those play a role. I think there were also very high expectations around the keynote at CES. And, you know, CES is a trade show oriented around consumer and automotive. And there were some really important developments that came out of the keynote around those markets. But data center is 85% of the revenue. And I think, you know, there may have been expectations that people wanted to hear more about that. So I think you have some of those issues. But, you know, overall, this is still a company in a very strong product cycle. And data center wasn't the focus here. It's investor focus, but, you know, it's still very strong. So I think it's a combination of some of the market issues that you talked about, as well as maybe some expectations issues around the trade show. But there was really nothing negative to
the street would really like to hear. I know that the revenue is expected for the fiscal year that ends this month, to come in at $113 billion, ramping all the way up to north of $200 billion by the fiscal year that ends in January of 2027. What do people want to hear on that front?
Well, you know, expectations are high. I think we're 2 months into the Blackwell cycle, the new products that they just started shipping. So I think to think that we were going to get any color on, you know, GB300 or incremental Blackwell products was probably just not going to happen. This wasn't the forum for that anyway. And I think so from a product standpoint, I think we know everything that we need to know. From a revenue standpoint, you're facing a little bit of a transition here, that you have Blackwell demand is very good. And you've heard these comments from Jensen in the past on CNBC talking about, you know, the level of Blackwell demand being insane. And he didn't really repeat those comments. But I think the issue that you're dealing with is Blackwell demand is really strong, but it's supply constrained. And Hopper, the sort of legacy product, still is the largest portion of that data center business. And so I think we'll still have a couple quarters here where there's meaningful upside. But I think the real upside is kind of into the back half of the year when you start getting that kind of full-blown Blackwell ramp. So I think, you know, people would like to hear that. And I think they did hear that in some sense. But I think, you know, they're trying to avoid those kind of really strong statements about Blackwell because it's not the main driver of the quarter. I think that's the combination of Blackwell and Hopper. So still quite optimistic about how this plays out. But I certainly see the upside being stronger in the second half of the year.
I mean, I guess the question is, with the stock that has done so well, tripled in value last year, how much of this is priced in? How much isn't? Where are you telling people? What's a price target that makes you feel comfortable? Yeah. What's a price arena?
Yeah, well, you know, at some point, this is less about the sort of phenomenon that this stock has been and a little bit more on valuing a growth company on its growth prospects, right? And stock trades at about 29 times our estimate for calendar 26. That would be high if there were any kind of deceleration in the business. But I don't think there is, even when we sort of go through these transitional challenges, if you will. Challenges, maybe overstating it. As you move through these transitional issues, you're still beating and raising. Those numbers are still quite likely to be moving higher. So I still think the stock is reasonably valued with good growth prospects this year and beyond. And again, the data points that support that are the strength in the Blackwell demand. And I think it's going to take a while for supply to catch up to that.
According to Morgan Stanley's prediction, Nvidia is expected to ship approximately 450,000 gigabytes 200 GPUs in the last 3 months of 2024, and up to 800,000 in the first 3 months of 2025. Other experts are still quite hopeful about Blackwell's prospects this year, although they believe it will scale a bit more slowly. By April, Blackwell revenue may potentially overtake Hopper sales, demonstrating just how quickly Nvidia's business can change. The fiscal year 2025 of Nvidia will conclude this month. It is expected to generate a record $128.6 billion in total revenue, which is 112% more than it did in fiscal 2024. According to recent quarters, the data center segment, which is driven by GPU sales, will account for about 88% of the company's overall revenue for the year. Compared to fiscal 2022, 3 years ago, when the data center segment accounted for only 39% of its whole sales, it represents a significant change. Because GPU demand is significantly higher than supply, Nvidia has pricing power and is now operating with very high profit margins. As a result, its earnings per share have more than tripled to $2.62 during the last 4 quarters. Based on that number, the price-to-earnings (P/E) ratio of Nvidia's stock is currently 56.8, which is actually lower than its 10-year average of 58.9. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Great to speak with you always. Just help us break through kind of the technical jargon and the complexities around the world of robotics. What is the biggest thing that investors need to know about NVIDIA's expansion into robotics here?
Well, thanks, Madison. I mean, look, it's a long-term play. That's the most important thing to know. A lot of this is not going to happen overnight. You know, NVIDIA has been in the autonomous car business, providing chips for autonomous cars and software for many, many years. And frankly, they were there a little too early. And so they kind of went in, and then they fell back out from the autonomous side. They always did the infotainment stuff, and now they're coming back in much more strongly. And one of the most important announcements that I think that Jensen made at his CES keynote, but I think got overlooked by a lot of people, is this idea of what they're calling Cosmos. So Cosmos is a software platform. It's an AI platform and a set of what they call world foundation models. And what it does is it allows you to do Gen AI for physical actions. And what that means is you can start to train things like robots and autonomous cars and other machines that react and do analog things in the physical world, but by using Gen AI training methods. And so what Cosmos can do is convert the physics of digital models and simulations into real-world physical actions, and then generate content for them to use and train. And that's been a huge stopping point, frankly, for robotics, and that's why it's a big deal and will have a payoff, but it's going to be down the road.
And Bob, one of the things that stuck out to us in your notes was you talked about exactly that, right? Some of these software initiatives and NVIDIA really transforming itself into a software company. What does that then unlock in terms of growth potential for NVIDIA?
Well, I think, and again, exactly right, Sean. I mean, that's the untold story, I think, around NVIDIA is that over time, we're seeing them do more and more of this software. They did Omniverse, of course, they've done their NIMs and their other foundation models, and they're slowly but surely building up this. And with software, of course, you get recurring revenues. You get these software licenses and all of those kinds of capabilities. And if you start to own the platforms for new types of technologies, then, you become the Microsoft equivalent for all these other worlds. So, we think about Microsoft on the Windows side, and we think about Google and Apple, on the mobile phone side. Well, maybe NVIDIA becomes sort of the platform for robotics. And they're working to do that, of course, with autonomous cars. Now, there's a lot more competition right now in autonomous cars. You've got Qualcomm has been very strong. Intel is actually trying to reestablish themselves in the auto side as well. But the bottom line is, that's the play I think that Jensen is trying to make, and it's a very smart one, but it's going to take a while before we start to see the real-world benefits.
In other words, Nvidia stock may still be inexpensive even if it has increased by more than 800% in just the last 2 years. Looking to the future makes the image much more alluring. According to Wall Street consensus prediction, Nvidia may make $4.43 per share in fiscal 2026, which begins next month, putting the company at a forward P/E ratio of only 32.6. That means that in order for Nvidia's stock to trade in line with its 10-year average P/E ratio, which is $260, it would need to rise by 80% over the course of the next 12 months. But by the middle of this year, Wall Street will begin to anticipate Nvidia's possible fiscal 2027 performance. Investors may be reluctant to push the stock as high as $260 if its remarkable run of success looks poised to cease. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.